For variance analysis, is the difference between the standard cost and the actual cost, which is already known. So we have different reasons why we have variances, differences in budget. The first one, adverse price variance. When we talk about adverse price variance, it means there's a sudden rise in the price of goods and services, or there's a sudden rise in the price of probably raw materials. And a sudden price rise might be as a result of suppliers. One supplier leaving the market. So if a supplier leaves the market, it means the supply in the market would reduce, and that might lead to shortage, which increases price. So that one is not budgeted for, but it suddenly happened. That is adverse price variance. I think it's clear. The second one, adverse labor hour variance. For adverse labor hour variance, it means an unskilled worker is doing the job of a skilled worker. So it's going to spend more time because it doesn't know how to do the job. For example, let's say maybe you have a teacher that does not know how to do his job or her job. So he is not skilled or she is not skilled for that particular subject. As a result, he or she might spend more hours taking that subject than those that are skilled. Do you get the point? That's what we call adverse labor hour. Then the third one, advanced material usage. For advanced material usage, we're talking about the use of inferior goods or training. So when you use inferior goods, whatever you produce will be inferior. You won't produce quality with inferior goods, yes or no? So it's a waste of resources because you have to rework it again. Another one is the training. Those that you are supposed to train to be able to use resources, you did not train them well, so they're going to waste resources. That is advanced material usage. Do you get it? And the last one, adverse rate variance. For the rate variance, it means the trade union, you know the trade union, right? They influence salaries, they influence wage rates. So they might have influenced the wage rate, but when they influence the wage rate, the budget for companies has been, submitted, has been executed before the wage rate increase. So that brings about adverse rate variance. Do you get it? There's a sudden change in the wage rate, but companies do not prepare for it in their budget. So it becomes an adverse for them. Is it clear? Please write.